Welcome, ladies and gentlemen, to a brand new episode of the Global Economic Outlook Report. Today, we're diving deep into the complex world of global economics, dissecting the intricate forces of inflation, low growth, and the myriad of risks that cast a shadow over the global economy. So, sit back, relax, and join us on this illuminating journey through the world of finance. Picture this: after a robust start to 2023, with lower energy prices and China's triumphant reopening, the global economic landscape is undergoing a seismic shift. But this transformation isn't cause for celebration, it's marked by economic twists and turns, with global growth appearing to stumble. What's behind this unexpected shift, you ask? The answer lies in the tightening of monetary policies across the globe. Central banks are pulling back on the money supply to combat inflation. Yet, as they do so, businesses and consumers are growing increasingly anxious. Confidence, once soaring high, is now on a downward spiral. So, what does all of this mean for the broader economic picture? Buckle up, dear listeners, as we embark on a journey to unravel the mysteries of these economic challenges. Global GDP growth, once a beacon of hope, is now projected to be somewhat lackluster. In 2023, we're expecting it to hover around 3%. Not too shabby, you might think, but here's the catch: it's set to drop further to 2.7% in 2024. The culprit? Well, it's precisely the tightening of macroeconomic policies we mentioned earlier. Essentially, we're putting a cap on spending to curb inflation. Now, let's zoom in on the heavyweight champions in this global economic showdown: the United States, the Euro area, and China. In the United States, the growth engine that was cruising at 2.2% in 2023 is expected to lose some steam. Picture a locomotive slowing down as it approaches the station. By 2024, GDP growth is projected to chug along at a mere 1.3%. But why, you ask? Well, it's those tighter financial conditions at play. When borrowing becomes more expensive, both businesses and individuals tend to scale back on spending, which, in turn, puts the brakes on the economy. Turning our attention to the Euro area, it's a similar story, albeit with fewer cheers. GDP growth is forecasted to ease to a paltry 0.6% in 2023. It's akin to a weary runner trying to cross the marathon finish line. However, there's a faint glimmer of hope on the horizon. In 2024, that growth might edge up to 1.1%. Why the change? It's because the adverse impact of high inflation on real incomes is gradually fading away. And finally, we land in China. China's powerhouse of an economy is set to experience its own set of speed bumps. With subdued domestic demand and structural challenges in property markets, it's expected to see its growth slow to 5.1% in 2023 and further dip to 4.6% in 2024. Now, let's tackle the elephant in the room: inflation. It's been grabbing headlines, and for good reason. While headline inflation, the one you see on the news, is slowly fading into the background, core inflation, the one that lurks beneath, is proving to be rather stubborn. Think of it as that pesky stain on your favorite shirt that just won't come out. Inflation is expected to gradually cool off throughout 2023 and 2024. But, dear listeners, don't expect it to disappear into the night. In fact, in most economies, it's going to stick around, like an unwanted guest at a party who just won't take the hint. Headline inflation in the G20 economies, which include the world's major players, is projected to ease to 6% in 2023 and 4.8% in 2024. Now, let's focus on core inflation in the G20 advanced economies. It's expected to drop from 4.3% this year to 2.8% in 2024. But, dear listeners, here's where things get spicy. Risks are lurking in the shadows, and they're not in short supply. Uncertainty, like the unpredictable plot twists in your favorite thriller novel, hangs heavily in the air. Will the effects of higher interest rates be more brutal than expected? Will inflation refuse to take a bow and exit stage left? The adverse consequences of those higher interest rates, like a rickety roller coaster, could turn out to be more stomach-churning than we thought. And if China's economy suddenly slams on the brakes harder than anticipated, it could send shockwaves through the global economy. Now, what can policymakers and governments do to steer this economic ship safely through these turbulent waters? Let's break it down into 5 key strategies. Mitigating financial contagion. Central banks, especially those in advanced economies, need to communicate their intentions as clearly as a crystal ball and calibrate their policies to avoid abrupt changes that might send shockwaves through global financial markets. Reducing domestic vulnerabilities. Emerging market and developing economies might have to tighten their own policies to prevent capital outflows and currency depreciation. Strengthening prudential standards, capital, and liquidity buffers in their financial institutions can shield them from spillovers. Restoring fiscal sustainability. Tax collection and administration need a facelift in many economies to shore up revenues. With grant financing dwindling, low-income countries have to prioritize mobilizing domestic resources and managing debt wisely. Reinvigorating long-term growth. It's not just about getting back on your feet, it's about sprinting ahead. That means accelerating productivity-enhancing investment, bolstering health systems, improving education, and promoting trade and private capital mobilization. Alleviating debt distress and strengthening the global financial safety net. International financial institutions need to be adequately funded to provide rapid support to countries in distress. Plus, we need mechanisms to sensibly restructure public debt, especially in times of crisis. Now, here's the question on everyone's mind: what can individuals like you and me do to protect ourselves during these uncertain times? Well, fear not, dear listeners, for there are steps you can take to safeguard your financial well being. Firstly, it's crucial to stay informed. Keep a close eye on the economic landscape, and don't shy away from reading up on financial news. Understanding the dynamics at play can help you make informed decisions. Consider diversifying your investments. Spreading your assets across various investment types can reduce risk. Consult with a financial advisor to create a portfolio that aligns with your goals and risk tolerance. Review your budget and cut unnecessary expenses. In times of economic uncertainty, it's wise to tighten the purse strings and build up an emergency fund. Lastly, don't underestimate the power of upskilling. In an ever-changing job market, acquiring new skills can enhance your employability and income potential. So, there you have it, dear listeners, a whirlwind journey through the intricate web of global economics. While the road ahead may be filled with challenges, remember that knowledge is your most potent weapon. Stay informed, stay diversified, and stay resilient. Until next time, this has been the Global Economic Outlook Report, your trusted source for navigating the ever-evolving world of finance.